People often tell me that they only own an S&P 500 fund. This is because returns have been great. But what if I were to tell you that comparing funds based purely on return can be very dangerous? In this video, I'll suggest a better way to compare funds. And finally, we'll apply this approach to some commonly used funds to see which ones look best. This video is sponsored by Incogni, an app that helps you take back control of your data privacy. You can understand the thinking of someone who chooses just the S&P 500. After all, Warren Buffett likes it, and Jack Bogle liked it. And if we look at the returns of the S&P 500 compared with other countries since the financial crisis, well, it's just outperformed every other country hands down. Its return has been close to 9% per year, and the closest performing country that comes second is Switzerland at just under 4%. So why not go all in on the US? So the way people seem to approach their fund selection when they're comparing returns is they create a table of fund returns ranked by performance. So best performing at the top, like we just saw, worst performing at the bottom. And then they simply choose the fund which has performed best. They invest into that fund, and then guess what happens? It may well underperform. Although that was a 16-year period, I actually cherry-picked the start time. And that's because after the financial crisis, the US has just done very well. Is that always the case? Well, actually no. If we compare the MSCI US index versus MSCI ex-US, so that's all of the countries in the developed world excluding the US, and I take the ratio of those two indices, well, when that number goes up, it's because the US is outperforming. And that's what you can see on this graph beside me. Notice how since 2008, yes, the US has done incredibly well. It's been a blistering performance. And that's been because of a combination of factors: very good earnings growth, very low funding costs, interest rates were pretty much zero over that period, huge amounts of VC capital flowing into tech funds, which blitz-scaled and basically became global companies. But the US has not been without its financial problems. For example, how about the period between 2002 and 2008? Well, that was when the dot-com bubble was in the process of imploding. And then, of course, we had the subprime mortgage crisis, where the epicenter was in the US. Or how about the much longer period between the early 70s and 1988? That was another atrocious period for US returns, and a very long one. So what we're going to do in this video is try and avoid that kind of mistake. There is a kind of recency bias here, and it's much better, I think, to have a more holistic view of returns, particularly taking into account the uncertainty and also the pure luck of some markets outperforming others, so that we're not beguiled by just one set of returns over a particular period. Today's video is sponsored by Incogni, an app that lets you take back control of your personal data. You may not be aware, but there are companies which can legally sell your personal data, and these are called data brokers. Now, personally, I hadn't heard of any of them, but the only reason I know about them is because I've been using the Incogni app in order to stop them using my data. Now, this is what the Incogni app looks like, and this is my dashboard, so you can very easily see any kind of removal requests you've got which have been sent to these data brokers. And at the bottom you can see the activity log, and this is an ongoing process, and you can use more than one email address. So you can see I'm on 20 suppression lists now, and I can also get a detailed view such that I can see all of the requests which have been sent and also the status of the request. So if I filter by high severity score, you can see that Sensia, for example, was high severity. Furthermore, it's now been suppressed. And the associated risks with that data broker are identity theft, spam mail and calls, data leaks, and so on. And if you're into privacy, there's a great blog which explains a lot of the concepts behind Incogni and also the problems of data privacy, which I think many of us simply aren't aware of. Now, for viewers of PensionCraft, there's a special offer such that you can take your personal data back with Incogni. Just use the code PENSION at the link below, and you can get 60% off an annual plan. So that link is incogni.com/pension, or just click on the link below. Let's start off with some real basic things when we're comparing funds to get that out of the way. Firstly, if you're comparing funds, make sure they're in the same currency. Sterling's been weakening for a while, so if you compare dollar returns and sterling returns, then the sterling returns will look better. If you're comparing funds in the UK, you have to be aware of whether they're income funds or accumulation funds. Accumulation funds reinvest the dividends and that increases their return. So just make sure you're comparing like with like. If you are comparing funds over a fixed period of time, later we'll see that's not such a good idea, but if you are, then make sure the start and end dates are exactly the same. Sometimes just a few days either side can change the return. Also, you'll notice that I usually use as long a comparison period as I can. Less than 5 years is almost useless. And that's because you're more likely to get a reasonable estimate of long-term returns. Over shorter periods of time, all sorts of factors can drive return up and down. And then finally, if you are comparing funds where you're making a choice between A and B, then just make sure they are comparable funds. Do they have the same degree of risk in them? Do they have the same style of investing, value, growth, quality? And are the goals of the funds the same? So these are all things you should just get out of the way before you actually go the next step and do what I'm about to tell you. So what should fund comparisons look like? The key thing is that you'll usually be thinking over some investment horizon, be it 5 years, 10 years, 20 years or more. If that's the case, then what's helpful is to actually compare funds over that horizon. But don't just use one 10-year period. Try and look at every single 10-year period there's ever been for that fund. That way, you won't be anchoring on a particular cherry-picked period of time. You'll consider every 10-year period. And if there is sensitivity to the start and end points, which there is for almost all equity funds, for example, then this is one way of avoiding that. So let's say we've got data on a set of funds going back to 1970, and we're going to be investing over a 10-year period. Well, we'd calculate the return from 1970 to 1980, then 71 to 81, and so on, and end up with many different 10-year returns for each of the funds. And then what we do is plot something called a box plot, which is just a very handy way of visualizing distributions. So beside me here you can see one of those box plots represented horizontally. The vertical white line is the typical case, the median return. 50% of the returns will be above that, 50% will be below. It's also the 50th percentile. We'll also consider the best case, so that's the upper whisker as it's called, you can see here. And we'll consider the worst case, and that's the lower whisker. And then the pink box, which you can see in the middle, contains 50% of the data. So there's a 50% chance historically you would have ended up in that box, with a quarter of the cases lying above the box and a quarter of the cases lying below the box. And those are the upper and lower tails of the distribution. But the key thing here is you don't just focus on the median case, the typical case, you also consider the dispersion around that central case. Another way of thinking of that distribution is which were the lucky returns that were exceptionally large compared to usual, and which of the returns were just unlucky and lower than usual. So those are the upper and lower tails, because when we're investing, we might not always be lucky. We could be unlucky, and it's good to know how unlucky we could be based on history. So now let's consider that framework when we're comparing two funds, A and B. Now in this case, you can see that these two funds are significantly different. Why do I say that? Well, if we look at the medians of those two distributions, their separation is greater than the error bars for each of the individual distributions, such that even if you were really lucky with Fund A, your return would have still been lower than if you were unlucky with Fund B. So clearly in this case, you choose Fund B. What's more often the case, however, is that the dispersion between the two, the difference between the medians, isn't very big compared to the error bars. In fact, it's contained within the error bars, in which case there's not a lot to distinguish between those two funds, even though recently one of them might have been performing very well, for example, such as the US. So how would this approach work in practice? Well, the first step is to visualize those distribution of returns and plot them alongside one another. Box plots are a great way to do that. There are other plots like violin plots, but the key thing is to compare the distributions and show the uncertainty of the distribution of returns. Secondly, you always have to consider some investment horizon, say 10 years, 20 years, or whatever it is for you. And that's because the uncertainty in return usually for investors is greater the shorter the investment horizon. And this is why we usually choose safer funds over shorter horizons, because equity is just so volatile, and in the worst case, you could lose lots of money. And then the third point is that once you discover the uncertainty around different funds, I think you're much more likely to diversify your investments. Instead of backing just the US, say, you will diversify across different countries. At least I'm hoping that'll be your take on this video. So using this analysis, let's look at different countries. Now this is data from MSCI, it goes back to 1969, it's just capital gain, it's not total return, which is why the UK looks so awful. But what really strikes me looking at this graph is if we look at every 10-year period since 1969, there's not a lot to discriminate between a lot of these countries at the top of the table. Sweden's been surprisingly good, but it's been very similar to the US. But notice how in that top 8 list of countries, if we look at the median return, that's the white line in the center of the box, it isn't really very different. It lies within the error bars. And if you cast your mind back, that suggests that outperformance over one 10-year period is likely to be just luck. So there isn't a significant difference between these funds, and we should be fairly indifferent between them. In which case it does make sense to diversify outside the US and incorporate other countries. So buying a developed market index or a global index is probably a better approach than putting everything into the US, where if you're unlucky, you could lose quite a bit of money, at least over the short term. We can do the same thing with investment styles. Now here I'm using the Simba dataset, which is from a spreadsheet created by the Bogleheads forum. And this has got a lot of great historical data. It's annual in return, but it's total return and it's real return. So it's inflation adjusted and the dividends are reinvested. And here what I've done is I've compared various investment styles in the equity market in the US alongside some treasury funds. Now the treasury funds are at the bottom of the table. And certainly for short duration treasuries, which are effectively money market funds, the returns are significantly lower than they are for equity. And that's true for almost any style of equity. Furthermore, that difference lies outside the error bars for the equity styles. So from that, I think it's pretty clear that money market funds underperform equity. So if you are investing for the long term, for 20 years in this case, then it's certainly worthwhile putting money into equity rather than money market funds. Now let's turn to the styles at the top of the table. The one which has been the blowout success since 2008 has been large cap growth. But surprise, surprise, that's not at the top of the table since 1976. In fact, small cap value, these are small cap stocks which are cheap, that's been the best performing style if we look at the median return. Furthermore, if you look at the dispersion, the error bars of large cap growth, it's got huge dispersion, a lot of uncertainty, such that in the worst possible return case, if you're unlucky, large cap growth has been very painful indeed, unlike small cap value. But what's also visible here, I think, is that the styles are all quite similar. The only one which seems to be pushing out at the top is small cap value. So when you compare US strategies, what this analysis shows you is that there isn't a huge difference between these different styles. And this is what makes me a little bit reluctant to pile into a particular style, like large cap growth. Again, many people that I speak to tell me that they just buy Magnificent Seven stocks in the US because they're the only show in town and they believe in tech. What this shows to me at least is that that's a mistake, and I think diversification across different styles is probably a good idea, and I wouldn't have a huge tilt to one style or another in case it's one of these unlucky periods. We can also look at global funds. Here I've compared the cumulative return of 4 global funds. These are all accumulation funds, all sterling denominated, all fairly large, with large assets under management. However, you can see a difference in return here. The fund at the top from Legal & General seems to be significantly better. So naively, you'd look at this graph and think, yeah, I put my money into that best fund. But is that outperformance just lucky? Well, we can use our analysis to check. And yes, I think in this case, it's pretty clear that it is lucky. The error bars are much wider than the differences between the median returns. So there is no significant outperformance here by that fund. This might have just been a lucky period. The one which is borderline underperforming is the Life Strategy 100 fund from Vanguard. And that's because it contains a lot of UK stocks. It's got a 6-fold overweight for the UK which over this period has led to underperformance. But as I always say with global funds, there's not a lot to discriminate between them. Certainly in terms of return, certainly in terms of this analysis, it seems as if they're fungible. You can substitute one for another. So don't sweat too much about choosing the best global fund. They're all quite similar. I think other criteria should dominate your decision, things like the one with the lowest fee. But it's not just funds that you can compare using this analysis. You can also compare portfolios. Now, Tyler, the creator of portfolio charts, is kind of obsessed with this selective choice of periods when comparing strategies. So he's done lots of analysis to look at ways to visualize this. So let's try something out using his portfolio charts app. We're going to go for 100% equity as a strategy. And this is based from the return perspective of someone in the UK. So it uses UK inflation and denominates the returns in sterling. And as we saw before, the black line you can see here is that strategy versus lots of other diversified strategies. And you can see that our performance has been unbelievably good. We've crushed the competition, or so it seems. But if we do a similar comparison to the box plots that we saw previously, here we've just got the ranges, that's the horizontal line, and the compounded annual growth rate over the last decade, that's the grey box which you can see here. Now for my portfolio, the 100% US S&P 500 tracker, yes, that's got the best return over this period. But what if we were unlucky? Well, in that case, you can see that this strategy, just the US, underperformed all of the other strategies in the worst case. Whereas the second item on the list, although it's got a lower return overall, it's just 5.8% versus 11.8% over the last decade. Notice the worst case for that, and that's for every 10-year period since 1970, its worst case is just under 4%, which isn't too bad at all. Certainly much better than the minus 7% that you got in the worst case for just US stocks. So I hope this has taught you the importance of these starting and ending points when comparing funds. If you simply buy something like gold or US stocks because they performed well over the last decade, just bear in mind that that could have been due to luck. And you should always consider the uncertainty of that return if you have more historical data. Now don't forget our offer from Incogni. You can take back control of your personal data just by using the code PENSION, PENSION, and you can also use the link below, incogni.com/pension, and that way you'll get 60% off your annual subscription, and of course there'll be a link in the description below. And, as always, thank you for listening.